Today I'm going to be sharing with you 5 companies that I'm planning to add to my portfolio in 2024. And these companies are not the usual companies you read about on the news. So hopefully some of those will be new for you. And they're not just random companies, but in fact 5 companies that have actually beaten and outperformed the S&P 500 in terms of total returns over the last 10 years. But before we dive in case you're new to the channel, my name is Kai, pleasure to meet you. This is my current portfolio that I'm having. That's the portfolio value, and I'm a long-term dividend growth investor. So if you're expecting meme stocks or stocks that double in value in the next few weeks, then honestly, I'm the wrong channel for you. I'm mostly talking about long-term dividend growth investing. Of course, I also own some crypto as well as real estate. So I do try to diversify, but my main focus and passion is for long-term dividend growth. And that ticks the box for the companies I'm going to be sharing and talking to you about in this video. Now, the tool I'm going to be using for that is Seeking Alpha. As you can see over here, that's honestly my favorite website that I've been using for doing all my various research. And as you can see, it also natively integrates with my stockbroker of choice, Interactive Brokers, where I hold the majority of my portfolios. And honestly, it's so seamless, it's so nice. I can customize my views. As you can see over here, I have my own view, so I can really display how I want to see it, which data I want to see. So it's really, really nice. You can easily deep dive into all the various holding stocks or do your research as well and have a nice summary, because previously I used to hop from site to site, Yahoo Finance, the various stockbrokers out there, and all of them offer some of the information, but I feel that Seeking Alpha gives me the most complete picture. Of course, they have a free plan where it shows you a little bit less information, but if you do end up paying for the pay plan, which I did for my own money, and I definitely think it's worth it because you get so much information really jam-packed into one single website, and it just makes things so much easier to research, to look into, and really get the information that you need to make the most qualified stock investment decisions for yourself. And if you do want to go for the pay plan, then please use my link in the description below. It will give you a free trial, and they often have various offers that they run to get a better deal, especially if you sign up for the annual plan, which I did as well. Right, so in addition to my Interactive Brokers portfolio that I have already over here, I also have a watch list where I basically just dump all the stocks that I want to keep on my radar and keep an eye on for future purchase. And as you can see right now, it's quite a number of them. And actually one of them, Microsoft, I already own, but it's with a different broker, so I still have it here on my watch list. But all the others I'm very much interested in and potentially want to add to my portfolio. But as I said, right now I want to focus on 5 companies that I picked from that list that I'm most interested in. And those 5, as I said, have actually outperformed the S&P 500. Now, of course, it goes without saying that past performance is not an indicator or guarantee for future performance. Just because they've done well over the past 10 years doesn't mean they will do so for the next 10 years. But for me, looking at those companies, it gives me assurance that they are strong companies if they continue for such a long term to outperform the market. Plus, I think the future still looks very bright and still has a lot of room to grow and continue to hopefully outperform the S&P 500. But of course, I'm not a financial advisor, so I'm just here sharing my own thoughts and investment journey, and hopefully some of it might spark some ideas or inspiration for your own decision, but ultimately it is your own decision. Without further ado, let's get started. And I'm going to be going in alphabetical order, and the first one we're going to look at is AbbVie. So this is basically one of the big pharma companies, and right now I'm holding already one pharma company, which is Pfizer, but I'm planning to add 2 more. You will see in a second one, but AbbVie has definitely been doing extremely well. Now, if you're not familiar with AbbVie, you can actually scroll down and see the company profile over here. So it briefly describes what they're doing. Obviously, mostly they discover, develop, manufacture, and sell pharmaceuticals worldwide. They also highlight some of their blockbuster medication that they've been famous with, and this is the biggest revenue contribution. Usually, a lot of the pharma companies have 2, 3, 4 big products that drives majority of their sales, which is often the 80-20 rule, right? 80% of the revenue comes from 20% of their products. So the same is true over here, but they're really well diversified and have a strong pipeline of new medicine. I don't want to do too much of a deep dive here, but just kind of give you an introduction of the company itself. Now, what I like about the company right now, it has a nice dividend yield of 4%, which is always nice. As a dividend growth investor, I like a good dividend yield, but that's not the only thing we're going to be looking at, but definitely nice to get that regular dividend payment paid to me. And I also like that they have a low short interest of less than 1%, 0.63%. And for me, that's something that's always interesting to look at, because if that number is, 3-4%, it means a lot of investors are actually betting against the company. And that's dangerous because it's very easy these days to manufacture bad news, and you just put it out, investors get scared, and the price tanks. Even though the company has done nothing wrong, it's purely based on speculations and bad press that sometimes a whole company can drop massively. So I'm really happy that people really not betting that much against the company. And if we click over here to the 10-year growth, I mean, that's really, really good with almost 200% return, really strong and really nice to see that. When we click over to see the financials, you can see also a continuous growth of revenues year on year. So that's really reassuring because I want to see companies that grow their revenues. If I start seeing a decline in revenues, that makes me wonder, if they're sustainable in the future. So if they continue to grow that year after year, that's definitely good to see and something I want to invest in. As I said, I'm a dividend growth investor. So in order to grow your dividends, you need to firstly grow your top line. So that's always a very important thing to look at. Then we come to dividends, and that's also very good because they have a payout ratio of less than 50%. That's very rare because a lot of companies, they have payout ratios of 60, 70, 80%, some of them even over 100%. That means they borrow money to pay the dividend, and that's not sustainable because long term, they're going to be running out of money. So 50%, I think is very healthy, very good. They have a very strong growth rate, and that's important. What I said, I'm a dividend growth investor, not just purely dividend, but I want to see the growth because basically that's an average growth rate of 10.52% over the last 5 years. And that's really, really good. And you have to ask yourself in your job, are you getting a 10.5% raise every year? Most likely not, right? But here, in terms of dividends, which is basically the equivalent of your income, you're going to get a raise on the dividend that you bought a few years ago every year at 10.5%. So that's really good. And they've done so for the last 10 years. So it's also starting to really build a strong history of dividend growth. They are paying on a quarterly basis, and I really like that because most of the European companies only pay on an annual basis, and ultimately the result is the same in terms of dividend payouts, what you get, the amount, but it's still nice to get it quarterly rather than annually, right? You wouldn't want to get your salary on an annual basis, right? And if I go over here into dividend growth, you can also see here for the last 10 years, they've really grown very nicely, the dividend. That's really reassuring to see. Of course, past performance is not a guarantee for future returns, but it's definitely encouraging to see. And then I want to go to momentum, click over here, and you can see how they performed versus the S&P 500. Now, if I click on a price return for 10 years, you can see they already outperformed them in terms of price appreciation. But then we add the dividend in there also. Let's go to 10 years. And you can see a huge difference. Now also the S&P went up, but AbbVie returned 344%. So that's really staggering, especially in recent times. They really took off. And honestly, that's really good to see. Even despite all these difficult years we had 2-3 years ago, they managed to perform very well. Now, of course, you can also look at ratings, performance analysts, etc., which is something I look at, but I don't take too serious because, just because some analysts say the company is bad, obviously if everything is red and it says sell, then I would do a bit more deep dive into it. But still, I don't really take it too serious because analysts, they make their money by making predictions. If they would be so good all the time, they would make millions themselves. It's still something I look at it. I'll take inspiration. Here it all says buy and strong buy, so that's encouraging to see. But as I said, in the end, it really doesn't really make a huge difference for me. Right, with this, let's move to the second stock I'm going to be adding to my portfolio, and that is Agree Realty Corporation. That's going to be the third REIT, real estate investment trust, I'm going to be adding to my portfolio. I already own quite a bit of Realty Income and Vici, two other really popular REITs, and I really enjoy REITs because I love real estate in general. To own your own is obviously very capital intensive and it takes many years to buy and pay off, etc. But if you still want to own real estate but don't have the money to get started, you can easily invest into the real estate investment trust. Many of those pay you a dividend on a monthly basis. Often it's quite high, as you can see in the example of Agree Realty. Right now the dividend yield is 4.74%, so really attractive in my eyes. And the market cap is still very low at only 6.27 billion. So in many ways I see this company to be a young Realty Income, because Realty Income is by far the biggest real estate investment trust in the United States. It's very popular, many investors investing, and I also love it, and I already have quite a big position. So I want to diversify away from them because I don't see massive growth for them in the future. The price might grow a little bit in the future, but the dividend will be the main attractive thing, which is quite high at the moment. So I think Agree Realty Income will actually manage to continue grow their share price as well as their overall market capitalization, in addition to attractive yield. So when I see here the 10-year return, 118%, but more importantly, when we go to momentum and compare it to the market performance over the last 10 years versus the S&P, it managed to actually outperform it. Not so much like AbbVie, but still 237% versus 211, which is really good. And I can even add Realty Income over here. And then you'll see actually Realty Income did much worse than the market and Agree Realty. So definitely, they only return 143% versus the market 211 and Agree Realty at 237. So in many ways, I really think they could be a future Realty Income. Of course, they have a long way to grow, but they have a very similar business model, many of the similar tenants. So I think in some ways they might be a bit of a competitor, but at the same time, I also think they can more easily grow into a much bigger company than it would be for Realty Income to do. When we go into dividends over here, you can also see a very nice dividend yield of 4.47%. As I said, the payout ratio is a little bit high, but that's very common with REITs. They're actually mandated to pay out a certain percentage, I think even over 80%, 80 to 90%. So that's really nothing to worry about. Still a very nice growth rate, and the dividend growth has been happening for the last 3 years. And the good thing, as I said, they also pay on a monthly basis. So now I would have two companies that pay me every single month, Realty Income and Agree Realty. So for me, I'm really excited about this, and I definitely plan to add this company for the coming year. Especially when I look at the revenues, you can see over here, year on year, they've been growing very nicely. So once again, very encouraging that they will be able to continue doing this, especially now in the high interest environment that we're in. It's obviously very difficult times for REITs to grow because borrowing has become so expensive. So that's actually difficult. So the fact that they still managed to grow their top line for me is really good to see. And I think once the interest rates will come down, the prices for REITs in general will definitely go up and we'll start seeing some nice returns there. The third company I'm planning to add to the portfolio is Lockheed Martin Corporation. Now, that's a company I heard about before in the past, but not something I ever really got into it. Now, as it says over here, it's a security aerospace company engaging in research, design, development, manufacturing for all different industries, space, aeronautics, but also a big part is defense. Now, some of you might be put off by this, and I do understand it, but looking at where the world is heading, I think countries will be spending more and more on their defense budgets. I think that company will definitely benefit as they are a leader in the space. And like it or not, but this is going to happen. And why not as an investor benefit from that? And I think there's nothing wrong with it. Same way how I invest in tobacco companies or fast food companies like Coca-Cola and Pepsi. Some might also argue that's not very good. But ultimately, we as investors have to make our own decisions. If you don't like it, that's totally fine. But in my eyes, I think it's a solid company that does a lot of good things as well, right? When we look at the 10-year return over here, over 200% price appreciation. So really, really strong. You can see the year-on-year growth over there. Of course, also low short interest, which is always good to see, and a relatively low dividend yield. Usually I say I don't want to invest in companies with less than 3% dividend, but in this case, it's still very attractive, and I'll show you in a second why. Especially considering that their growth rate of 8.81% is quite attractive, and they have been growing it for the last 21 years. So that's really astonishing to have such a long continuous growth of the dividend. You can see it year after year after year, they have been growing the dividends. So really good to see that. And going back into the momentum chart to see how they did versus the S&P 500 over a 10-year period, once again, really outperforming it, especially in total returns with the dividend reinvested, 211 versus 295 for Lockheed Martin. I mean, that really speaks for itself. Solid performance, very strong. And yeah, I'm really confident that that number will continue to shine in the future because, as I said, countries and governments will spend more and more on defense. Plus, of course, they're not only doing defense. So that's the good thing. If, let's say, defense goes down, they're still going to invest in airspace and many other niches and sectors in there. So that makes me really bullish on them long term. And with a market cap of 111 billion, which is quite high, obviously, but then we look at Apple potentially hitting 4 trillion in the future, I still think they have a long way to go to grow that number even more in the future. One interesting thing also over here, you can click on peers to see similar companies or competitors in the space, and you can see a number of them. One of the bigger ones is RTX. So if I go down over here, I can click on total return, select 10 years, and you can see the difference. Lockheed Martin almost 300% versus RTX only 50%. So it's really important that you choose the right company, because even in the space, if the management or the company is doing poorly, in the end your investment goes downhill. So it's very important to choose the right company. So I think with Lockheed, you're definitely going to be in good hands, at least in my eyes. Next up, we come to a company that many of you heard about in the news because everybody speaks about it pretty much every day, the S&P 500, right? We all know the index, but there's actually a company behind, and that's S&P Global, which is a company that does many things such as indexing, providing credit ratings, benchmarking, analytics, workflow solution in the global capital, commodities, and automotive markets. So yeah, it's actually a real company behind all these various indexes that puts these things together, does credit ratings. So it's really, really good. I recommend you go on the website S&P Global, and they do great things. And when you look at the returns over 10 years, you can see 461% increase. I mean, that's really mind-boggling and really interesting to see those returns. And what I like about it, it's a data company. They can really scale a lot without needing too much manpower and payroll therefore, right? And that as an investor, it makes it very attractive. They're going to be leveraging more and more AI to do a lot of the things for them to further lower their payroll, but still be a leader in the space, because without a trusted provider of data, those markets wouldn't really work, right? So it's a super, super important and relevant company to have in the global capital asset markets. But of course, at the same time, as a dividend growth investor, the yield is very low. So that's probably going to be one of the lowest yielding companies I'm going to be having in my portfolio. But at the same time, I can see the long-term price appreciation of that company. So I still get a dividend yield, so that's good, because I wouldn't want to have too many companies without any yield. So that's still nice to get that dividend payment from them on a quarterly basis. But looking at the revenue growth over the last few years really is encouraging to see, and really makes me excited to see what's ahead for them. But if we also look at the dividends, while it is low, the 5-year growth rate has actually been extremely high at 12.47%. And they have been paying for the last 50 years growing the dividends. I mean, that's mind-boggling and amazing to see that despite so many years, they're still growing at such an aggressive rate, and the payout ratio is less than 30%. And makes me very confident that they have a long way to continue to grow and pay the dividends. And when you go onto dividend yield, you can also see here the yield on cost. So as the stock price continues to grow, the dividend yield equivalent to the price that you paid, let's say 10 years ago, would be an equivalent of 4.61%. So you can see here, the longer you hold on to it, your yield on cost will increase, and that's really good to see. So if we click onto momentum over here, I can see here the total return over a 10-year period versus the S&P 500. I mean, more than twice. You can see here S&P 211 and S&P Global 524%. I mean, mind-boggling and really exciting, and definitely a company I want to start dollar cost averaging my way into. And lastly, the 5th company I'm planning to add to my portfolio in 2024 is Thermo Fisher Scientific. Now that will be the 3rd pharma company technically in my portfolio, in addition to Pfizer, AbbVie, as I mentioned at the beginning, and now Thermo Fisher. They do so many things, but also a big focus on manufacturing all the ingredients, so to say, that the other pharma companies need in order to manufacture their pharmaceuticals. So I had the pleasure and privilege myself to see one of the manufacturing units, and I mean, it was mind-boggling. Such a precision, it's unbelievable how everything is perfectly planned and outlined. And of course, the results speak for itself. If we look at over the 10-year, the price appreciation, 378%. Really, really great to see, and a real powerhouse. And I think the future for Thermo Fisher is bright. Once again, the dividend yield is actually negligible. Here, you're really buying it for price appreciation. Now, yield on cost, we'll come to in a second, obviously looks very good, but mostly you buy it for the price appreciation in the future. As I already have quite a number of high yielders, I can afford to include a few of low yielders to kind of balance it off and instead benefit from price appreciation. Short interest is obviously very little, but despite the low dividend yield, you can see here the 5-year growth rate. That's actually the highest across all of the 5. And that's 15.5%. That's really, really high. And they have been growing it for the last 6 years. And you can see the payout ratio is only 6.35%. They're so profitable, and they only pay a very small part of that for investors. So there's a long way to further grow that number as the company matures. So I'm really confident that that number will only go up in the future. And once again, when we compare to the S&P 500 of 211% over the last 10 years, Thermo Fisher returned almost twice that of 393%. So really, really good returns there. So there you have it. These are the 5 stocks I'm planning to add for 2024. I think it's a nice balance of some high dividend yielders, especially AbbVie and Agree Realty, then a medium yielder and medium growth with Lockheed Martin, and lastly some low dividend yielders but high growth with S&P Global and Thermo Fisher. Let me know in the comments what you think about these companies, and also which ones you're planning to add for the coming year, and I'll be very excited to look into them. If you enjoyed the video, please give it a like, subscribe to the channel, it means the world to me. Next up, check out this video over here. As always, thanks a lot for watching, stay healthy, get wealthy, and I'll see you in the next one. Ciao!